joining us from Sydney this morning, we got Michael McCarthy, Chief Market Strategist at CMC Markets, and Mike has almost 3 decades experience in the financial markets. Mike, some scary times here. What do you advise to investors? Do you just run for the hills?
Well, the first thing we point out, Susan, is that sentiment is the key driver of markets at the moment. And in sentiment-driven markets, we throw the economic fundamentals out the door. This is a time to be in cash. It's a time to be doing homework, to be checking for value opportunities and waiting for that sentiment to abate to come in and pick up those bargains as the pressure comes off the markets.
Yeah, but what about Europe? This is all stemming from the European side, of course, and now the concerns shift to Spain from Greece. Do you expect a euro breakup this year?
I think it's very possible. We can't say it with any certainty. It's an evolving situation. But one of the interesting aspects of the market behaviour there is the German bond market. The 10-year bonds hit another low at 1.4%. And under the best-case scenario, Germany will have to stump up cash to help get Europe out of this situation. Under the worst case, it's going to be severely disrupted by a breakup of the euro. Under either of those conditions, it's impossible that the bond markets could sustain these low yields, and it's one of the areas of focus for our traders.
Yeah, and don't forget, often for fixed income space, we have the dollar on a record 14-session run. So how long do you think the selling might last for? Mike, I'm going to have to ask you to look into your crystal ball here.
Well, how long is a piece of string, Susan? It's a tough call, but I suspect that until June 17 and the new Greek election, we're going to have periodic bouts of volatility. We're expecting that. We're looking to take advantage of that. We've got some customers looking ready to sell insurance into the share markets when they get hit hard, because we typically see a blowout in volatility in that cost of insurance. Overall, though, it is a time to remain cautious, and we're seeing that reflected in the performance of the sectors. It continues to be the defensive spaces, the telcos, the utilities, the property trusts that are doing the best at the moment.
Okay, so Mike, you're saying hold cash for now, but look for buying opportunities. Where are they, and how do you know when to get in?
I find it hard to go past the Hong Kong market. I like the China A shares. I think that at the moment we're seeing a number of global businesses, particularly in Japan and Australia, that are being driven lower by sentiment. They have sound business and sound earnings prospects. I'm thinking particularly of those Japanese electronic companies and the Australian resource companies, and they're the areas where I'm running my ruler at the moment, waiting for the low prices that I think will come over the next few weeks.
And what are your expectations for monetary easing, either from China, either from the U.S. side, or even more help coming from the ECB?
At the moment in the US, it's quite clear the conditions are not there. It was interesting to see the Fed add an additional caveat. It said it needs to see a severe deterioration in conditions or a significant rise in the external threat, read Europe. So they've readied themselves, if there is an extremely disruptive event, to move to the pumps again. However, they've made it clear that's not the situation. I'm not sure how much room the ECB has to move here. I would note, though, that an interest rate cut, which has previously been ruled out, is one tool still available to the Europeans. I'm not expecting that to come into play anytime soon. The problem for all of these central banks is, of course, the competitive devaluations that are going on around the globe. And while they have been, to some extent, effective, that strength in the US dollar you're pointing to shows that eventually the effect starts to wear out.
Yeah, and you know, more expectations for quantitative easing as well. That's being put on the markets. So you know, with the weakness that we've seen in these U.S. Economic indicators, not only jobless claims, but to fully fed manufacturing. I mean, I think that really was one that's hammered sentiment. Do you expect the Federal Reserve to come in with another round of QE?
Well, I'd also point to the fact that we're also seeing some stronger than expected data out of the US. The housing starts and the industrial production, for example, were surprising on the upside. Overall, the trend in US data is actually positive. Now, you can't detect that from the market action we're seeing at the moment. Those economic fundamentals are being ignored while the threat from Europe remains. I'd argue it's on the balance of the data in the US, it's quite clear recovery is coming through. It's not a strong recovery, it's quite modest, but the turnaround we've seen in unemployment, that ongoing trend, although the numbers slightly disappointed last night, they're part of a trend towards lower unemployment. And while that remains the case, we give the US economy a tick overall, and we give the Asian economies, particularly China, a tick overall. So what we're looking at in investment terms around the globe is a 2 out of 3 scenario.
Yeah, and I got to ask you, Mike, you know, this is obviously the biggest talking point in the markets. What about Facebook?
Well, it seems like it's 1997 all over again. These valuations, depending on whether we look at the operating profit or the net profit, we're talking about multiples of 55 to 104 times earnings. And while it's not impossible that a company could grow at a rate to justify that, that requirement that Facebook continue to grow its revenues by between 35 and 50% for 6 years at the current valuation is, for mine, too big a stretch. And I won't be looking to trade this one from the long side.
Yeah, really rich valuations. Micah, thank you so much for your time today. Micah McCarthy, Chief Market Strategist at CMC Markets.